Gold is moving higher this week, but the rally has a ceiling, and two familiar forces are holding it there. Here is what is happening and why it matters if you're watching the gold market. The US dollar pulled back in recent trading, and that gave gold room to climb. The relationship between the two is straightforward. When the dollar weakens, gold becomes cheaper for buyers using other currencies. That draws in demand and pushes prices up. We saw that dynamic play out again this week, with buyers stepping in to use gold as a hedge against currency softness. But the rally did not run far before it hit resistance. The first break is inflation. Price pressures are still sitting above the Federal Reserve's 2% target, and that complicates things for gold. You might think high inflation is automatically good for gold, and historically, the metal has served as a store of value when purchasing power erodes. That part is true. The problem is what the Fed does in response. When inflation stays elevated, the Fed keeps interest rates higher for longer, and higher rates are a headwind for gold because gold pays no yield. It earns nothing while it sits in a vault or a portfolio. That makes it less competitive when interest-bearing assets like Treasury bonds are offering real returns. Which brings us to the second break, rising yields. When Treasury yields climb, the opportunity cost of holding gold goes up. Investors who might otherwise buy bullion can earn a solid return just by holding bonds instead. That trade-off reduces the urgency to own gold and has been a recurring theme through much of this year. Every time gold has tried to rally, yield pressure has shown up to cap the move. So right now, the gold market is caught in a tug-of-war. On one side, dollar weakness and safe haven demand are providing a floor under prices. On the other side, sticky inflation and elevated bond yields are limiting how high gold can go. The market is essentially range-bound until one of those forces gains the upper hand. Traders are watching Federal Reserve communications closely for any shift in tone. A clear signal that rate cuts are coming could change the math quickly. So could a meaningful drop in inflation data or a sustained slide in the dollar. Any of those developments could push gold out of the range it is stuck in either direction. The practical takeaway here is simple. If you're tracking gold, keep your eye on two things above all else: incoming inflation reports and what Fed officials are saying. Those are the catalysts most likely to break this standoff and set the direction of the next significant move. Bullion Flash is brought to you by Absolute Bullion, a California-based dealer in gold, silver, platinum, and palladium. More at absolutebullion.com.